All right, number 5 here, we're selling the hot dogs that we had purchased earlier. We're selling 400 of the hot dogs and getting 700 from customers. Now, how you record this entry, you might think you would record the cash coming in, which increases your assets by $700, and then you would look at this as, well, we gave up hot dogs and buns, which is inventory. When we bought those hot dogs and buns, we increased inventory. So now we're going to give up that inventory. So that's going to decrease our assets, but only by $400. Your inventory can't be decreased by more than what you put in that account in the first place. So we can only reduce it by 400. So by doing that, hopefully you can see that this isn't correct because it doesn't balance. What we have here is a half correct answer. So how do you go about doing the correct answer? Well, what's missing here is we haven't reflected the fact that when you make a sale to customers, you're increasing the shareholders' wealth. And if you look under this column, we're showing nothing. So let's go through how you would do it correctly. So what you need to do is you actually have to make 2 entries. You have to record the sale, I call that the good entry, and then you have to also record the cost of that sale, the bad entry. So let's go through. What you're getting is the cash, so that is the same. You increase your cash account, which increases your assets by 700. But now what we have to remember is that when you provide a service or deliver a good, which in this case we're delivering hot dogs and buns, we have revenues. And that's the purpose of being in business. We're trying to generate lots of revenues. When you do that, you increase shareholders' wealth by 700. So when out goes a good or a service, when you deliver a good or a service, you get revenue in exchange for an asset, in this case cash. So we're going to increase our revenues. So that looks great. That's why I call that the good entry. Our assets have grown by 700. Our shareholders' equity has grown by 700. What we haven't reflect though is the fact that we had to use this asset, the hot dogs and buns. So let's go through that. Now I'm going to go through what we gave up first and then talk about what we get. So we gave up our hot dogs and buns, we gave up our inventory, and that decreases our assets. That's what we had done earlier. But now we're out of balance. What this inventory is that what's happening is we're using those hot dogs and buns. When you use an asset, that's an expense, and this expense is titled cost of goods sold, and that decreases shareholders' equity by $400. So the using up of an asset, and in this case it's inventory, you have an expense called cost of goods sold. So we're going to match the price of the hot dogs and buns with the cost of the hot dogs and buns. If you look at this entry now in its entirety, we're showing that we have profits of $300. Now you don't just record the 300 because this is valuable information for the readers to know that the price was 700 and the cost was 400. So remember when making a sale that you have 2 entries to record. And this sale again is applicable to merchandisers and manufacturers. Service organizations don't have inventory to have to worry about, so recording sales for a service organization is simpler. You would only be recording the asset and then the service revenue.